China just gained the upper hand in a war America thought it was winning. The Sant demanded Beijing surrender its currency weapons, yet it was the dollar that collapsed. Now US factories are choking on their own tariffs. Ocean freight from China down 60%. Retail shelves could run dry in 5 weeks as Washington scrambles. Trump's ordering Britain to cut ties with China, only to be met with silence. Meanwhile, Beijing's playing the long game. This isn't policy, it's economic warfare. So, what happens when your biggest ally stops following your playbook and your biggest rival starts writing the next one? Scott Besson's call for China to maintain a strong yuan while the US dollar weakens wasn't just bold. It may have been structurally self-defeating. The US dollar index has plunged nearly 10% since January 2025. But instead of fueling a manufacturing boom, it's inflaming cost pressures across US supply chains, still reliant on Chinese components. The tariffs Washington imposed, some reaching as high as 145%, were designed to force China to pivot inward. But with intermediate goods blocked and domestic industry underbuilt, the dollar's fall is feeding inflation rather than exports. You can't devalue into a supply shortage, said Mark Zandandi, chief economist at Moody's in a recent note, warning that the combination of tight inventories and import costs was a perfect storm. Meanwhile, the yuan has remained remarkably stable, devaluing just 32% year-to-date, showing that Beijing isn't folding, it's watching. And with $17.2 billion in net short positions placed against the dollar last month, according to CFTC data, global markets are betting Besson's gamble is already spiraling out of control. The US dollar index dropped nearly 10% between January and April 2025, falling from 105.2 to 948, according to Bloomberg. A plunge that was supposed to spur exports, but instead triggered higher input costs for US manufacturers that is gaming an incredible Carrefour. This still dependent on Chinese goods. Meanwhile, China's yuan has held relatively firm, slipping just 3.2% over the same period. A stark contrast to the 14.5% devaluation during the 2018 trade war. As Scott Besson called for a stronger RMB and a weaker dollar to rebalance global manufacturing, Chinese policymakers quietly took advantage. The People's Bank of China cut its one-year loan prime rate to 3.35% in March, fueling domestic demand without currency instability. The dollar decline is now working in Beijing's favor, says HSBC strategist David Bloom, who warned that a soft dollar with no industrial substitute in place creates stagflationary conditions instead of export growth. The contradiction Besant failed to resolve is now being exploited by China with precision and patience. US retailers are now caught in a countdown they can't escape. As of April 2025, shipping volumes from China to US ports, especially Los Angeles and Long Beach, have dropped by 61%, according to data from Flexport and Panga. The National Retail Federation warned in a joint statement that inventory levels across major chains like Walmart and Target will begin to show critical strain within 5 to 7 weeks unless imports normalize. The culprit? Tariffs that now range from 75% to 145% on core goods like electronics, auto parts, and textiles. That's pushed costs up across the board. The average landed cost of consumer electronics rose 32% year-over-year, according to UBS, while the price of imported furniture has surged 45%. Meanwhile, the CPI for core goods rose 11% in March, its sharpest monthly spike since 2021, signaling inflationary pressure from broken supply routes. And yet, Washington insists the tariffs are temporary leverage. If that's true, the clock is ticking loudly. When Besant called for a rebalanced global economy led by US manufacturing, he overlooked one foundational truth. America's industrial ecosystem is still under construction. According to the Federal Reserve's March 2025 Industrial Production Report, U.S. factory output contracted 0.6% month over month, while capacity utilization slid to 76.8%, both signs that reshoring efforts remain years behind. Simultaneously, core producer prices rose 13% in Q1, driven largely by elevated costs in construction materials and imported machinery, both of which rely heavily on Chinese suppliers. And the labor market isn't filling the gap. The Bureau of Labor Statistics reported a 17% year-over-year drop in U.S. manufacturing job openings in February. Without stable inputs, skilled labor, or scaled domestic output, the weaker dollar becomes a cost multiplier, not a growth catalyst. As economist Mohamed El-Aroun noted in a Bloomberg panel, this isn't dollar diplomacy, it's dollar dysfunction, and the markets are responding accordingly. Beijing's central bank has shifted into a tactical stance, using the falling dollar as cover to launch targeted stimulus while preserving export competitiveness. The yuan has traded within a controlled band of 7.19 to 7.25 against the dollar since February, even as the US dollar index slumped. That stability gave the People's Bank of China room to inject over $1.5 trillion, or $210 billion, into state-owned banks via low-interest lending facilities, according to Kin. Meanwhile, exports remain strong. China's March trade surplus hit $13 billion, led by a 17% increase in shipments to ASEAN countries and Latin America. Per customs data, they're effectively buying time to rotate growth inward without triggering capital flight, said Alicia Garcia Herrero, chief economist for Asia-Pacific at Natixis. Beijing's playbook isn't reactionary, it's surgical, and by keeping the yuan stable while the dollar drops, China is managing to defend both its factories and its monetary flexibility. The UK now finds itself at the intersection of geopolitical loyalty and economic reality as US pressure to sever trade with China escalates. Peter Navarro's April 2025 comments in The Telegraph, labelling Britain a compliant servant of Communist China, accompanied a behind-the-scenes push from Washington for London to halt Chinese imports redirected from the US market. But the numbers don't support immediate decoupling. In 2023, China supplied 7.3% of UK imports and just 4.1% of its exports, according to the ONS. Cutting those ties would directly hit key sectors, especially electric vehicles, where British EV manufacturers rely on Chinese batteries and components that have no immediate European substitutes. Chancellor Rachel Reeves responded bluntly, stating, "It would be very foolish not to engage with the world's second-largest economy." Meanwhile, the London Stock Exchange is evaluating Shine's IPO despite bipartisan scrutiny in Parliament, indicating that pragmatism still has a foothold. So the question is no longer whether the UK wants, it's whether it can without detonating its own industrial future. Despite sharp rhetoric from US officials like Peter Navarro, who in The Telegraph accused Britain of being a compliant servant of Communist China, London is resisting American demands to sever ties with Beijing. Chancellor Rachel Reeves publicly warned that disengaging from the world's second-largest economy would be foolish, especially as the UK faces stagnant productivity and widening trade deficits. According to the Office for National Statistics, China accounted for £62.6 billion in UK trade in 2023, nearly 7% of total goods movement, critical for sectors like electric vehicles and pharmaceuticals. The UK is also pursuing Chinese investment, including a potential Shein IPO in London, signalling divergence from US decoupling strategy. A leaked cabinet briefing reported by The Guardian showed internal resistance to Washington's tariff-based coercion, with one senior advisor calling US demands economically self-destructive. While Washington escalates, Britain is calculating, quietly pivoting toward resilience, not alignment. Peter Navarro's April speech claimed, If the Chinese vampire can't suck the American blood, it's going to suck the UK dry. But that narrative is unraveling under scrutiny. China's outbound foreign direct investment into the UK dropped 27% year-over-year in 2024, according to Rhodium Group, not expanded. British regulators have also blocked Chinese involvement in nuclear and telecom infrastructure, including Huawei's exclusion from 5G, a move led by MI5 Security Advisory. Navarro's framing ignores these facts, instead pushing ideological alignment at the cost of strategic nuance. The UK has taken calculated steps, not capitulation, says Fiona Hill, former US National Security Council advisor. The danger lies in mistaking inflammatory analogies for policy. London sees trade as a negotiation table, not a battlefield. And it's betting that moderation, not maximum pressure, is the currency that holds value. With both economies under pressure, the trade war is no longer about leverage, it's about optics. Trump, facing a Q1 2025 GDP contraction of 0.3% and a 1.1% decline in real wages, is scrambling to frame tariffs as victory, despite soaring import costs. Xi, meanwhile, is juggling 5.3% youth unemployment and a property sector that saw a 22% year-over-year drop in housing starts, according to China's National Bureau of Statistics. This is now a two-level game, says Dr. Went Tai Sun of the Australian Centre on China in the World. Both leaders are managing foreign brinkmanship while signalling control at home. Trump's narrative centres on reclaiming industrial might. Xi's narrative focuses on resilience and multipolar strength. Neither leader can afford to blink first because behind every customs declaration is a political campaign ad. And as domestic pressure builds, so does the risk of policy distortion overtaking economic logic. Publicly, both Washington and Beijing claim they're ready to talk. Privately, neither wants to be the first to move. The Chinese Ministry of Commerce said it's assessing negotiations, while US Treasury officials insist the door is open. But that ambiguity is strategic. A Weibo account tied to China Central Television stated bluntly, the US must be the more anxious party. Meanwhile, Treasury Secretary Scott Bessent told IIF delegates there's a real opportunity for a big deal if China's serious. This vague posturing reflects a diplomatic tactic known as constructive ambiguity, used historically in US-Soviet arms talks and now repurposed for economic warfare. It's about preserving face while probing for compromise, says J.N. Chong of the National University of Singapore. If countries are forced to choose between dollar-centric security and UA-enabled affordability alliances, could fracture. What emerges may not be a new bloc, but a tangled web of economic loyalties, shaped less by ideology than inflation rates, labour costs and shipping lanes. The world isn't decoupling, it's repricing. So let me ask you, who's really shaping the future of trade? Governments or investors? Is this just a phase in a larger standoff, or are we watching the birth of a new world order without a single centre of gravity? Drop your thoughts in the comments. We're glad you're enjoying this video. Please like and subscribe.
Have come to the table with the intent to negotiate or put forth proposals. Of course, we have not seen any concrete trade deals yet, but that number of countries does continue to seems to continue to grow. And he also addressed China and sort of emphasized the comments that you heard from the president yesterday in the Oval, that there is a deal to be made. But again, Mugo, the markets are up today. Those comments do seem, from what we heard from Bessent, to align with what we heard yesterday, but still no concrete deals on the table right now.
And I'm sure there's so much that you could probably speak to on this, Kelly, but I'm always surprised by just how much a little comment here and there can move or shake the markets. It's just so interesting to me. All right. Something else that we know is raising eyebrows is the European Union just slapped hefty fines on U.S. tech giants Apple and Meta. So what's all this about?
So this wasn't unexpected. There's something called the Digital Markets Act in the European Union, and they take a much harder line towards tech companies than we do here in the U.S. And so what they sort of have come to determine is that Meta and Apple have violated that act. Together, they're going to be forced to pay over $800 million in U.S. dollars in terms of fines. And what they're saying is that Meta illegally required users to either share their data or have to pay for an ad-free service, that sort of trade-off, that choice was an illegal one, and that Apple didn't properly inform their users of different opportunities available outside of Apple's App Store. Now, the specifics of it, that's one thing, the fine, sure, but I think what's really interesting here is whether this elicits any response from the White House or sort of any development in this trade war. Because remember, the president has not just said that this is about tariffs, but also about certain things that prevent American companies from operating in other countries. So something to watch there.
Yeah, we'll see if the president has something to say about this one. Okay, we are getting a look at Tesla's first quarter earnings report. What is the takeaway from all of this, and how is Elon Musk responding?
Okay, so they missed on the top and the bottom line, and their automobile revenue was 20% lower than last year. That wasn't unexpected. We know that Tesla has been having trouble with their sales and their brand. The big takeaway, though, was not about the numbers in the report last night. It was what Elon Musk said on the call, that he plans to scale back his time at Doge starting next month. That is certainly something that investors wanted to hear. They want to hear him focusing on Tesla. That's partially why the stock is up today, even though they did have that big miss on their earnings report. And then the other thing that I think was interesting was he said that he has made it clear to the president that he doesn't think high tariffs are a good idea, even though Tesla is one of the best auto companies poised to get around that tariffs because they assemble their cars in the U.S. But I found that interesting on the call last night when I was listening, that there was just an admission that he doesn't align with everything with President Trump, Mugo.
Oh, yeah, for sure. Very interesting. Kelly O'Grady, as always, thank you for joining us in 24/7.